The US dollar has dominated global markets for many years. Investors' nervousness over the US market will have far-reaching consequences, both at home and abroad. In the year 2025, the dollar marked its worst start to a year in over 5 decades. The last time the dollar began a year with such a steep decline was way back in 1973, when foreign currencies stopped being linked to the dollar. And that move came 2 years after President Nixon made a decision to no longer link gold to the dollar. And a big part of the reason the dollar has been the world's reserve currency is because US economic policy has been predictable, has been process-oriented, and also has been rules-based. And right now, all three of those are sort of up in the air. And so it's clear that the global reserve managers have an incentive to try to diversify away from the dollar as US President Donald Trump ramps up his tariff rhetoric. And for what it's worth, the US administration might welcome that, as that would actually help fulfill the administration's objectives of reducing the US dollar's trade deficit. One of the clear implications is reserve flows reallocating is that interest rates are likely to be higher, not just in the US but globally as well. A weaker dollar would likely push inflation somewhat higher. If not the dollar, then what? The challenge, of course, is that it's not clear what the alternative asset to the dollar is. And there isn't another currency that serves the same role in the global economy. Most other currencies are not as freely traded or are not as liquid. The economies on which they are based are not as large. And that makes it a tad bit difficult for a dramatic reallocation of foreign exchange reserves. That said, we are seeing movement around the margins. The changes in US policy are providing enough of an incentive to force reserve managers to look elsewhere. Certainly, we have seen appreciation in the euro that goes beyond what is cyclical fundamentals would dictate. And there has been a large increase in the price of gold as well. A weaker dollar will hit emerging markets dependent on exports more, and this would widen the gap for most of the emerging countries to be able to sustain their lower foreign exchange reserves. Trump's tariffs have already led to a shift in global trade plans, and a weaker dollar with no real alternative will likely hit emerging markets hard.